Well, good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I want to introduce you tonight to Charles St-Arnaud, who is the chief economist at the Credit Union Central Alberta. He's written quite a little bit lately that I found interesting on the Canadian housing market, on the economy generally as well, but we're going to focus in to start with on the housing market. Charles, welcome to the show.
Thank you. Nice to having me.
I appreciate you joining us. You're from... You're coming into us from Calgary, I presume.
Yes, I am.
Are you from Calgary originally?
No, I actually grew up in Montreal.
In Montreal. I sort of wondered about that. How do you like Calgary?
I really like it. It's a city that actually punched way above its weight in terms of quality of life.
Yeah. You're a skier?
Yeah. A little bit, but I'm more of a hiker, and I love the outdoors, so having the mountain next door is really nice for that.
Excellent. So I think you've been pretty negative on housing, and mainly because of interest rate increases. And what I see recently is that you were calling for a house price drop of 30%. Tell me, what's your attitude toward house prices?
Well, I wouldn't say calling per se. I think one of the things that we need to look is what in some ways has sustained house prices or allowed house prices to increase so much over the past decade in Canada. And a big part of it, when you look at all the data, valuation metrics, affordability, and it was the fact that over the past decade or so, we've had record low interest rates, which allowed people to pay for more and more expensive houses without, still by having relatively low mortgage payment compared to history. The problem is that now those low interest rates have disappeared quite rapidly, and that changed dramatically affordability. So, for example, in Toronto, housing affordability hasn't been so low ever. On 40 years of data, it has never been so bad in Toronto.
On 40 years of data, it's never been so bad.
Yeah. So it's even worse right now than in the early 80s when interest rates were 21%.
Now, there was a chief economist at Wood Gundy in 1990 that made his name based on calling for a 20% housing decline when anyone else was saying, no, it's not going to happen. Are you that same guy that's calling for the big decline?
I wouldn't say I'm calling for the big decline. I think what's going on now is that affordability is so low, nobody can afford really to come in the market as a new buyer. Something has to give. If interest rates stays like they are, the only way to have an adjustment is having price to fall to allow consumers or households to come back to the market.
Now, some people say that supply is so limited that Canadian Mortgage and Housing is saying that you need 1.8 million more homes, that Doug Ford's saying you need 1.5 million more homes, that there's so much NIMBYism in municipal councils that supply is not there, that Trudeau's going to let in 450,000 new immigrants, that you're not building more water, et cetera, et cetera. And so therefore, no, you're wrong. Housing's going to stay flat or go up.
Yeah, well, that's one of the reasons why I think there might be what might be the future is that we might be in a case where we have permanently expensive houses. So households should be expecting to spend a bigger percentage of their income towards shelter than they've had in the past. So that kind of could put a floor on prices, but it's still the affordability crisis is not going away overnight. That's one of the things for sure.
So household debt as a percentage of income in Canada is twice what it is in the United States. Why should we have twice as much debt relative to our income as Americans just because our house prices are so much higher? Is there something wrong with our economy?
It's not just our house prices. I think if we look compared to history, the U.S. had a big correction on the housing market. They had a big deleveraging on household debt that happened during the financial crisis of 2008 and 2009. Canada never had that adjustment. We went through the financial crisis relatively unscattered in comparison to what happened in countries like the U.S., the United Kingdom or Spain or Ireland.
So we all
So
thought that was good, or what you're suggesting, that that's bad? We should have gone through that correction?
Well, it
Maybe
depends.
creative
Is that at some
destruction
point,
is actually healthy. Wasn't there an economist back in Germany that argued for creative destruction?
yeah, it's actually from the Austrian school. I think it was Hayek who was arguing that, and it's not a bad in some ways. Recession helps to remove excess in the system, and that's part of the excess. But the issue with debt is that debt on its own is not necessarily bad. The issue is at some point, too much debt creates vulnerabilities in the system and makes you more vulnerable and more affected more by shocks. So right now we have a big increase in interest rates, and a lot of households that have a big amount of debt suddenly have a higher level of debt service that they need to pay. So a greater share of their income needs to go to service that debt, either mortgages or non-mortgage debt. So, but then the issue is that it makes you also vulnerable because the size is that what happens if you have a change in income? Because at this point, it's an impact on household. It's higher debt service payment. But so far, households have been able to kind of rebalance their budgets, so cut into discretionary spending to pay for more debt. But what happens if we start to see a big rise in unemployment, and suddenly those households that need two income to support their debt lose one of those incomes? That's where the danger goes.
We're chatting tonight with Charles St-Arnaud, who is the chief economist at the Credit Union of Central Alberta, who's written quite prolifically of late about interest rates, about mortgage debt, about housing prices, etc. We're going to take a break and be back in 2 minutes with Charles. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Charles St-Arnaud. We're talking about housing, house prices and interest rates, etc. Charles is the chief economist at Credit Union Central Alberta. Charles, you were saying that levels of debt aren't really an issue or a problem. I guess they're not until interest rates go up and or incomes go down. But that sort of almost sounds like Justin Trudeau, who used to say the deficit will take care of itself. Like higher debt's got to be a problem, isn't it? It's got to make you, more risk averse. It's got to make you less flexible, less sustainable. It does make you more susceptible to increases in interest rates, less susceptible to income declines, to housing declines. Like in any business, debt would be higher levels of debt would mean a less sustainable company. You'd put a bigger beta on it, a greater degree of risk. In personal life, isn't greater debt, twice as much debt, a problem?
Yeah, well, that's what I meant by it increased vulnerability in the system. It's that as long as you can pay for that debt, it's fine. It's just that if suddenly economic condition changes, so obviously a lot of the debt we have in Canada, a lot of it was accumulated pre-financial crisis, as you had financial innovation that allowed households to get more into debt, and very similar to what we've seen in the US. So we've had big increase in household debt, but also over the past decade, with very low interest rates, it was very cheap for households to accumulate that debt. So for the same level of debt they would have had in, let's say, in the 80s or 90s, they were paying probably a third in interest, even less. So it was easy to accumulate greater amount of debt with less cost. The issue is what happened when conditions change. One, we're seeing higher interest rates over the past year, so that changed a lot of the math on debt. To give it in very simple means, the increase in interest rates we've had over the past year on the average house in Toronto, it's about $1.2 million. That's an increase of almost $40,000 in interest payment on the first year. That's a lot of money. Most households don't have $40,000 laying around that they can pay an extra cost of interest on their debt. So that's the issue with debt, is that as long as conditions are fine, as long as you have an income to support that debt, it will be okay. Also, we have to take into account that debt is static in time. Like the debt that you take now, even if inflation is 10%, if you take 10% interest, if you take $1,000 of debt today, even if inflation is 10%, it will still be $1,000 next year if you don't reimburse the principal. But your income might be increasing because you'll have wage increase. So you have some slight sustainability with time, but the income part is very important. Is that when you start to have a shock on your income, that's when debt sustainability gets out of control.
You're the smart economist. I'm not, but I disagree with you because I think it's more expectations of price increases. I think people were willing to borrow all that debt, put all that debt on the house because they said, yeah, it's this much debt now, but the price increases are going to go up. So I'm going to have a lot less debt in a couple of years. And that was proven out by what was happening. And, I know lots of people, you probably do as well, that were refinancing their homes a year or two, maybe investment houses, a year or two, or condos, a year or two after they bought them and buying another one. With the refinancing. And it was all based on not expected inflation increase in housing, but actual increases in housing.
Yeah.
But it's turned around today, either because it's flat or because you say it's going down. And that's going to have a dramatically negative impact that these people that have borrowed against the equity in the second and third and fourth condo that they bought, if housing prices go down all of a sudden, it's going to have a huge whammy, isn't it?
Oh, yeah. The ramification of a correction in the housing market will be important, especially for those who, one, overextended themselves, especially those who have more than one mortgages and all that, those who have overstretched themselves, that they had the fear of missing out and just went in and bought whatever they could find at any price and never looked in terms of, okay, can I make my payments if interest rate goes up? So that's a pocket of the market that should be a concern.
But in addition, can you answer your question? When you think about building an economy, we've built an economy in Canada where the average house in a suburb of Toronto is twice what the average house in the suburb of Dallas or Chicago would cost. Maybe not New York, but our housing is twice as expensive. And I've seen comparisons, you've probably seen them, of cottage country in Ontario versus cottage country outside of Boston, New York, etc., where as well, cottages are twice as expensive. People are living with twice as much debt. Why have we created an economy that is so much more expensive than our American cousins?
Well, again, it's hard to make complete comparison. There's different regulation. Like I said, also, the US had their own housing correction in 08, 09 that we didn't have in Canada. So they some of the adjustment, they've done it more than 10 years ago. Second is, I think one of the issue is we're probably, people don't want to say it, we're in an overvalued housing market. And part of it was rates were very low for a long time. People were able to overstretch themselves to buy more and more expensive and outbid themselves to stretch. And that fear of missing out is like, well, I'll just make a bigger bid to come in. There's also structural factors. We've had an issue in Canada that our population is growing relatively fast, but our stock of housing is not increasing.
So you're arguing that because of lack of supply, the housing prices are going to stay high?
There's a lack of supply. The issue is prices might not be able to stay high because nobody can afford it. So there'll need to be a correction.
So before the Bank of Canada started jacking up interest rates, The Economist magazine said we were at a housing bubble like a year ago.
I would argue probably, I would say the housing market has been flashing on my dashboard since 2013, 2015, easily, in terms of being expensive.
So some people say that, if there's a correction that has to happen, it's good to get the correction over early, because otherwise you're going to have a bigger correction in the future. And you're saying that it's good that we didn't have the correction that the Americans had. Maybe it's bad that we didn't have the correction that the Americans had, because we're going to have a bigger correction if it ever comes?
Well, that's what I'm saying. Is that I wouldn't argue that it was good or bad that we didn't. I was just saying that the U.S. had a correction, and that changed dramatically their kind of level of house prices. There's also a lot of different things. Like, for example, it's hard to compare housing in Texas and housing in Canada. Zoning in Texas is much more different. It's much easier to build new houses in many of those places than it is in
Houston,
Toronto.
yes, not Dallas.
Again, I cannot compare exactly, but there's still supply is much easier in many parts of the U.S. So it's easier to keep price low with supply. So that's the issue.
Okay, hold it. Is that good or bad? If regulation is more lenient or quicker, and so therefore it's easier to add supply, and so therefore housing prices stay down, is that good or bad?
Well, it keeps it affordable. It depends on how it's done, because it's also that the kind of supply also matters. There's always a big question: does it make sense to create even more urban sprawl, or should we be promoting densification? I don't mean that everything needs to be 20 floor condo towers, but sometimes it doesn't. In some areas, it doesn't make sense to just be building single-family homes. But so there's that also. It needs to be also cleverly made for what is needed.
This Bill 23 that the Premier of Ontario has recently put forward really is trying to force municipalities to allow greater densification. So it's not that we've been supporting densification. If anything, we've been anti-densification.
Yeah, but that's the thing, is that I think over the past 20 years in Canada, we've had an issue of not wanting to really expand our supply, or thinking hard in terms of how do we do it in a better way. Because, like I said, part of the issue we have is that we have a supply issue in Canada, and that's keeping price higher. At the other end of the spectrum, we also have to take into account that, do politicians really have an incentive of moderating price increase or creating policy that could lead to decline in house prices? Those homeowners are voters. So putting regulation that brings price down is not popular, doesn't get them reelected. It's what I call often as an economist, is that there's a difference between good policy and good politics.
And so you're saying the good policy would be to make housing more affordable, but the good politics is make sure that all those baby boomers that have built up net worth in their homes keep their values up to finance their retirement pensions.
Well, it will be harder to justify. Suddenly you put policies in place that change the dynamic very quickly.
You recently issued a report on the Bank of Canada hiking the interest rates by 25 basis points, and then said you thought they were going to hold on that. So you don't think they're going to increase it anymore?
I think we're probably done here. I think we're seeing the inflation dynamic slowing. Inflation is still high, but we're starting to see some sign of moderation and some easing in the broad inflationary pressure that built up during 2022. So they can feel that they've done their job, but it depends. Does inflation continue to moderate? So that will be something to see. But for at least the next 4 to 6 months, most likely they're done.
You think for the next 4 to 6 months they're done with interest rate increases?
Yeah, and if inflation continues to moderate, then they'll be happy and keep it unchanged. But if inflation doesn't moderate as quickly as they want, we could still squeeze 1 or 2 extra rate hike at some point.
And if interest rates stay flat, is that arguing for not a decrease in housing prices, or do you still think that, do you need more rate hikes for housing prices to go down?
No, I think the change has been big enough. Like I said, the 425 basis points that was put into the system over the past year is having a dramatic impact. Like I said, just in Toronto, that means that someone who buys a house now has to pay almost $40,000 more in interest just on the first year. So that's a big shock on the interest payment. And that changed for most households. It really dramatically changed their calculation in terms of what they can afford and the type of house they can go for.
Yeah, no question. Well, it's biting into everybody. There's no question about that. So are you arguing therefore for a recession, a mild recession, or no recession?
We'll probably have a mild recession. The risk is really what happens if we get a bigger recession than expected. Because the amount of household debt that we have, the amount of the correction in the housing market, businesses are also relatively indebted in Canada. How the higher interest rate will work its way and impact those segments of the economy will matter a lot. And we might be actually more sensitive to a higher interest rate than we think we are. So the risk is that, well, what happens if the recession is stronger? What happens if the unemployment rate increase more than we think? Like currently, I'm forecasting that we'll probably have unemployment rate going to 6.5% by the end of the year. So it's a marginal increase. We're roughly at 5% at the moment. So it's in the grand scheme of things of Canadian history, even 6.5% unemployment rate is quite low. But the risk is, well, what if the slowdown is bigger? What if businesses start to lay off more than we think? We know they have labor shortages. They might not be so quick at getting rid of or laying off their workers because they'll be worried, can I rehire them when I need them? So they might be slower to adjust the labor side of their business. But we don't know. If they start to lay off more, we know a lot of households need two incomes to support their high level of debt. What happens when you have a significant amount of households that have lost their jobs and have to fall behind on their debt? So that's, in my view, that's probably one of the tail risks for 2023.
One of the tail risks is that you could have higher unemployment than you're currently projecting, and that will have a spin-off effect on everything else.
Yeah, bigger slowdown, bigger job losses, bigger. Then you kind of have that feedback loop where households start to default on their loans. People who have to, they're forced to sell their house because they can no longer afford their mortgages, creating then an extra supply on the housing market and pushing even more prices lower.
Now, in the last couple of years, we've had a fairly dramatic increase in government deficits and debt because of COVID payments, et cetera. Do we have room left for the kind of fiscal stimulus that would typically occur during recessions?
We have some fiscal room. The big question is always the debt sustainability. What is the level of debt relative to your economy? So debt to GDP is important there. Is that do we get into a bad dynamic like we had in the 80s or 90s, where actually debt to GDP was just constantly increasing and gradually increasing at a faster rate? And by the late 80s, the debt was so high and so expensive to service that we were spending, if I remember correctly, I think we were spending wasn't it 25 cents on every dollars of federal revenues that was going to just to the interest on that debt. We're not there yet.
You don't think we're there yet?
We're still no. Oh no, they did it. We're not at those kind of levels at the moment. Yes, the debt has increased. Yes, we had massive deficit during COVID. I would argue, and I think that's one of the big things that's important to take into account, is that what would have been the alternative? I always put myself, if I was a government in March, April 2020, you've put restriction on the economy. The unemployment rate went from 6% to 15, 16% in the space of 2 months. You have a responsibility to act and to support the vote of the economy in general, to ensure that it doesn't degenerate into a bigger economic crisis. We know now in hindsight that it was probably too much. But when you don't know what to expect, when you know that you have such a big share of your economy that's not open, and such a big amount of unemployed, you have to do something. So I think on that front, I would leave it aside. Then it's more going forward. I think I would be more, for me, the big concern is there's not enough thought put into how can we actually improve growth in Canada, not just spending to help. Can we improve innovation? Can we improve our productivity? Canada is one of the laggards in the G7 and OECD country in terms of productivity. Productivity creates wealth. That's where it needs to be. So if you can improve your what we call potential growth, that's where it should be. So basically investing in our future.
Now you sound like you're quoting from our former Minister of Finance's new book that says we've got a productivity problem and a lack of growth agenda and a prosperity agenda in Ottawa. Fascinating. We're talking tonight with Charles St-Arnaud, who is the chief economist at Credit Union Central Alberta. We're going to take a break for some messages and be back in just 2 minutes with Charles for some more. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Charles St-Arnaud, who is the chief economist at the Credit Union Central Alberta. We've been talking primarily about housing and interest rates, et cetera. But I wonder, Charles, you've got an interesting view coming from Montreal, now working in Calgary, of the Alberta economy. And I'd love to chat with you about the Sovereignty Act and Danielle Smith and stuff, but you told me I can't ask you about politics, which is too bad, because I'd love to ask you to compare Sovereignty Acts and stuff like that in Alberta versus Quebec. But we'll ask someone else to come on to talk about that. But Alberta economy, tell me what you think about the current Alberta economy, because you know what, we hear on the Toronto subway all the time, Alberta advertising for us to move out there.
Yeah, well, there's reason for that in some ways. Is that we were talking about housing earlier, and yes, as much as Toronto hasn't been that expensive in more than 40 years, well, house prices in Calgary are actually only slightly more expensive than has been on average of the past 40 years. So we haven't had the same excess on the housing market that we've had here. So you can, for example, well, the average house prices, including condos and semi-detached and all that, is about $550,000 in Calgary.
So about half the price of Toronto.
Yeah, a detached house you can find something very good for $650, $700. So it's a big difference. It's
go west, young man.
Different. That's the reason why the government has been putting a lot of emphasis on that. That we especially for young couples with children that are desperately needing or wanting to buy, that can no longer afford Toronto and Vancouver. Calgary and Edmonton clearly has an advantage.
But I hear the office vacancy in downtown Calgary is like 20-30%. So, are there jobs?
There are jobs. I think the issue is, one is for office vacancy, is that Calgary or the Alberta economy I've been in a quasi-recession from 2015 to almost 2019. When oil prices tanked in 2015, that created a massive shock on the economy, and on the economy that was actually booming, but kind of in an unsustainable way. There's been a lot of office space that was built very rapidly because vacancy rate was close to, or extremely low. But as the oil boom stopped, nobody needed those offices anymore, and now there's kind of a overhang of office space. So I would call it kind of the typical boom bust cycle of the Alberta economy that often moves with oil prices. But what's been very interesting over the past, I would say, year and a half, is that oil prices have boomed, in part because we've had a big increase due to the reopening post-COVID. And then you also had the invasion of Ukraine by Russia. So we had earlier this year oil prices of about $120 a barrel. But when we look at the data, the value of oil being produced in Alberta has never been so high. So if we look at the data for the whole year of 2022, oil revenues have been 25%. Well, Alberta's produced for about $11 billion per month of oil. The record in 2014 in the previous boom was 7.7 billion. Yet, even though we've had a boom, like we're reaching record level of value for the oil production, and in terms of volume too, the volumes also continue to increase because all the investment from the early to mid 2010s are now maturing and continue to increase. Yet, even though you kind of normally those would have been prime condition for another oil boom and kind of in Alberta, yet we don't have a boom similar to what we have in 2014, even though the value, the revenues of oil producers have never been so high ever.
So what's
happening? Well, the industry has changed, and the way those revenues are being used is changing. Less of those revenues are actually staying in Alberta. On one part, traditionally, back in 2014, oil companies would have returned about 6-7% or so of those revenues to shareholders in terms of dividend and other types of return to shareholders. Now it's almost 25% of those revenues that are returned to, actually 20% that are returned to shareholders. But the issue there is that when you look at the big oil producers in Canada, well, the percentage of Canadian shareholders is extremely low. On average, it's a bit less than 25%. So 75% of those flows back to shareholders are actually not even staying in Alberta and even less in Canada. So we're not seeing the benefit on that front. Then the other big change is that originally, like in 2014, about 25% of oil revenues were reinvested in the economy by doing new investment in terms of building new oil sand mines around Fort McMurray and other type of oil projects. Now it's about 7% of those revenues. So there's less, like I said, there's less and less of those revenues that are actually staying in the economy and generating the same economic impact. So the economic spillover of the oil industry this year has been much lower than what we've seen in the previous boom. Then another factor is that what explains why we don't see the same amount of boom is that the type of investment is also changing. Like in the early 2010, oil companies were doing investment. They were just investing massively into building up new production. So they will have new oil sand mine projects, and those projects are very capital intensive early in the cycle. So for example, an average oil sand project costs about $40 to $50 billion in the first few years to build. So and you need to hire a lot of workers, construction workers to clear the land, prepare build the road, build all the infrastructure. Then you have the machinery and equipment that kind of have a lot of spillovers to construction sectors, to the manufacturing, and so and so. But right now, the way the oil industry is investing, they're no longer investing in improving or increasing dramatically their capacity. What they're doing is that they're realizing that the name of the game in the oil industry is you need to be the lowest cost producer with the lowest greenhouse gas emission. So all the investment goes into how can we squeeze efficiency gains from our current operation. So with what we have right now in terms of capacity, both in terms of workers and machinery, can we squeeze extra barrel out of that to lower our cost per barrel dramatically to bring them as low as we can? And then can we find efficiency in terms of better use of our resource to reduce our carbon emission, and doing research in terms of how can we apply carbon capture and sequestration to lower our carbon footprint? Because they've realized that that's the only way they will be able to survive long term in a changing energy environment.
It's fascinating because what you're saying, I think, and if I remember your numbers right, is that the amount of profit that's been returned to shareholders has gone from 6% to 25%. And so a dramatic increase in the amount of money that companies, oil and gas companies, aren't keeping to reinvest in their own businesses, but to return to shareholders. And typically, one would think companies do that when they don't have opportunities to invest that would be greater than the cost of capital within their own their own hurdle rates within their own company. But what you're saying at the same time is that they realize they've got to, reduce carbon footprint, increase carbon capture, increase efficiency, become a low-cost producer, etc. Why aren't there therefore those opportunities to do that and spend money in their own company? Why are they just returning it to shareholders? Why? Some people think when companies return money to the shareholders, it's effectively management saying, I don't know what to do with cash. I've got no good opportunities. I'm not good enough to go look for stuff.
Yeah, well, there's partly that. Partly is also we have to take into account that 2020 was a very bad year for the oil industry. When oil prices went to zero in April 2020, a lot of those oil companies had to take on a lot of debt and also applications.
So then they should have paid down debt, not returned money to shareholders.
Debt is also being reimbursed. Actually, debt repayment is not part of those. It's part of what they're using those revenues on too. So there's also that.
Okay, well, that's disappointing that they're not spending more money in investing in themselves and making themselves more cost effective and maybe some alternative energy programs. I got to ask you, Charles. 11 months ago in March of last year, you wrote an article about a sharp rise in global commodity prices, inflation expected in the coming months, and said the government of Canada, the Bank of Canada, should increase its interest rates to 2%. That's what you were arguing back 11 months ago, to 2%.
Yeah.
Seems like a million years ago it was 2%. Why was the Bank of Canada so slow and so minimal in its increases to respond? When even you, in March of last year, were arguing that they should be more aggressive.
Yeah, I would argue there's different reasons. One is the shock was not very well understood by most economists. One is most economic models are not calibrated for those type of big shocks. Because unfortunately, it's calibrated on what happened on average in history, and you don't necessarily have those big shocks. Two is where I think we've missed the boat is the shock we've had in terms of increase in energy prices. To put it in perspective, the increase year on year in energy costs in Canada is almost comparable to the first oil shock in 72, 73 in terms of magnitude. So there's a lot of non-linearities that were not captured early. I would agree, we probably erred, we should have been, but there's also the thing is that, do you want to be too aggressive? That, I think, it's probably one of the falling of economists, is that we don't want to be too dramatic. So that might be what kept us behind. But to come back to energy prices, that I think has been a combination of various shocks, but the energy shock has a lot more spillover on different part of the economy. Because one, if we think about Canada, everything we consume has a component that's transportation cost. So when diesel price double within the space of a couple of months, well, those costs are very hard to absorb. Transportation companies start to charge surcharge on their clients. Those clients pass more of those increase to their customers. So the size of the shock meant it was more easy. It got transmitted more than what we would have expected in the past because it was not absorbed as much by profit margin. And like I said, transportation costs in Canada, everything we consume from food to clothes to furniture, even services actually have a big component of energy. Even if you're just an insurance company. At some point, if your electricity bill double within a couple of months, you will feel that you will need to charge your customer more, even though you're not technically directly affected. But I think that's one of the part where we kind of miss completely the impact.
Fascinating. We're chatting with Charles St-Arnaud, the chief economist at the Credit Union Central Alberta. We've been talking about housing prices. He thinks that they're going to decline, thinks they should decline, isn't positive they will, but thinks they should decline. Thinks that interest rate increases are probably flattened out for a while, thinks we're going to have a mild recession, thinks that we've got high levels of household debt. And while that's bad, it's going to sort of stay there. And it's going to be a question as to whether the recession is deep and unemployment goes up, as to whether or not it's sustainable, and it's going to have a big or a not so big impact on the economy. And he thinks that we all should move to Calgary like he did, because housing prices are half the price there than they are in Toronto. We're going to take a break and come back with some concluding comments in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Charles St-Arnaud, who is the chief economist at the Credit Union Central Alberta. If you don't follow him on LinkedIn, you should, because his writing is prolific and really quite interesting. And as I mentioned, 11 months ago in March, he was calling for inflation before I thought a lot of us were actually thinking it was going to be an issue, and was asking the Bank of Canada to increase their policy rate up to 2%, which sounds like it was a long time ago. And it's interesting. I think shows what you said earlier today is that what makes good public policy doesn't necessarily make good politics. And while you think that the good public policy would be cheaper housing prices, you don't think that makes good politics, because too many people that have built up net worth in their homes would suffer. That's an interesting comment. I wonder, sir, if you were the governor of the Bank of Canada, or if you were the Minister of Finance, or, give me one and then the other, given the situation that we're currently in, what would you do?
Well, let's start with the Bank of Canada. I think Governor Macklem did a great job considering the environment. Yes, they might have been slow to increase interest rate because they should have started earlier. But from where we stand now in 2023, I think they can feel that they've done a good job, and I would probably be continuing the way they're doing. So keeping rates where they are for the foreseeable future, and see how much of a deceleration in inflation we get in the coming months before deciding on next policy moves. So like I said, I think 4.25 in terms of policy rate is the right thing to do. On the fiscal side, I think that's where there's a lot more that should be done. And I think one of the issues we've had, and we discussed it earlier, is that there's not enough thought put into how do we grow our economy. We've had an issue of productivity in this country for decades. It's not something that has happened over the past 5 years. It has been, we've been productivity laggards in the developed world since, I would say, probably the late 90s. I remember when I was studying economics at university in the late 90s, we're already talking about it. So it's not something new, and it's just surprising that 20 plus years later, we're still talking about it. So something needs to be done. And I think that's an area where I find the Ministry of Finance should be putting a lot more effort in terms of how, because, well, our productivity is our future wealth growth. So if we can grow it faster, we're all winning.
Well, I can't agree with you more on your second point. I think that our productivity growth has been dismal. I think that the statistic, and you'd know this better than I, but that real incomes haven't grown in something like 5 years in Canada. And I think the vast majority of people, the only real benefit they've got is either through increased debt or because of cheap consumer prices on some products. They haven't actually made more money in disposable income. And I do think that when you think about your issue of politics versus policy, and the issue of high and twice as high debt and prices, house prices in Canada versus the United States, one of the potential solutions is to get the incomes up. If you can't get the debt down and the house prices down because of bad politics, maybe getting incomes up is one of the potential solutions, which is like your comment about growing the GDP. So the debt doesn't matter as much if you grow the GDP. So let's grow our own personal GDP. And we can only do that through our productivity. I do think that one of the historical successes of Canada has been our natural resources, and I think that has created huge amounts of GDP and of revenue and profitability and jobs, etc. And it bothers me that the oil and gas companies have been returning so much money to shareholders, and they haven't been able to find good projects that they can invest in. And so I think that is a problem. I hope no one thinks that I'm calling for a new national energy program, but I think that is an issue. On your first point, though, I've got to respectfully disagree. I think that core inflation hasn't come down. One of the reasons why headline inflation has come down is because energy prices have come down, and that plays a role there. But with mortgage interest rates up, with rental rates up, with food prices up, I think that you're going to have increased unionization and increased labor bills and labor wage increases, et cetera. With all that, I think inflation is going to be stubbornly high for a little bit longer than you think. And I think the Bank of Canada is going to have to be a little bit more aggressive and is going to have to continue the rate hikes. And I really worry about China. And I would be very interested in what's going to happen as China reopens and re-enters the global economy, because it's really been not as in there for the last couple of years. And The Economist magazine had a big cover story on the impact of China that you probably noticed. And I think that's going to have a huge potential impact on the global economy. Some people think it's got to add a couple points to GDP growth, which has got to add to inflation. And if China adds inflation and a continued war with two spring offenses, one on one side and one on the other side in Ukraine and Russia add to inflation, and core inflation stays high, boy, I hope the Bank of Canada doesn't allow inflation expectations to get set in that middle single digit or even high single digit range and does something to bring it down. But if they do, I think your 30% decline might actually come true in house prices, which is a real shocker and could devastate a lot of people. What do you say to that?
Well, I would say the risk is probably there. You were talking about China reopening. That's one of the place where I'm looking for inflationary pressure, but it's not necessarily in terms of, it will be mainly through commodity prices. That's where we'll start to see is that as they reopen, they'll be consuming more oil and other commodities, and that might be generating some, or we might not see the stabilization in commodity prices that we were expecting. So that's probably a risk, and I wouldn't be surprised. Actually, that's one thing again, we're talking about risk, and it's always the thing when we do forecasts is that you have your base case, and then
on the one hand and on the other hand,
well, you don't have a choice. Is that's where it could go, but what if? And that's where I'm starting to look into, and could we have another small oil shock in the second half of this year, where with China reopening, more demand for oil, we haven't had big increase in supply. We still have Russia that's being completely shut off of the market. OPEC is not increasing its quotas either. So could we get the risk? Could we start to see some increase in energy prices as we go into the end of the summer to the fall? There's still some issues, for example, in the US in terms of refining capacity remains an issue. So could we get to a point where, similar to what we've had a bit last spring, where that was part of the issue for high gasoline prices, is that refiners couldn't transform more oil into gasoline, so creating a shortage and higher prices. Same with diesel not too long ago. Could we recreate the same condition later this year that perpetuate inflation longer? Again, it's a scenario that could happen, but we will see. If we come back to inflation, where I find some comfort is that when we look at the dynamic on core inflation, yes, core inflation is still high, it's still above 5%, but the dynamic is slowing quite dramatically. If we look at the increase over what I call the acceleration and deceleration of inflation, so we look at the 3 months increase versus the previous 3 months, because the problem with inflation is that it's the change in price compared to last year. But who cares about what happened to price in March and April last year? What we want to know is that how did price change and what's the recent dynamic, so we can actually see does that recent dynamic continue. And the recent dynamic is much smoother. Core inflation is growing at between 3 and 3.5%, still above what the Bank of Canada is targeting, but it's that slow, that kind of that momentum has slowed.
Well, you called it right a year ago, so I guess we should listen to you now. Charles St-Arnaud, thank you so much for joining us. I really appreciate it.
Thank you for having me.
Come back again. I remind you, everyone, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online, even from Calgary, Alberta, at www.saga960am.ca. Thanks for joining us, Charles. Thanks for joining us, everybody else. Good night, everybody.